And on today's show, why LTC planning makes such good sense. Part 3 of this week's series on why long-term care coverage is essential with long-term care expert Maria Sarchi. Hi everyone, I'm Steve Savant, syndicated financial columnist and contributing author to Backroom Technician in Innsmouth. Let's get down to business. Well, welcome to the show, Maria.
Thank you, Steve.
If you've missed any of our show with Maria and I, we've been talking about this now for a couple days. I like you to watch it in chronology. You know, it really helps you kind of get a taste of how we got to today's show, right?
Yeah, we built some building blocks as we went along, talked about the big picture, why this is even important to be talking to clients about. Now today we're going to get into the economic impact of a care event and what it can mean to a client.
Well, I'm just reading the stats on this. I mean, it seems so overwhelming. It says the cost of care in this country averages, this is the average, not even,
right.
It could be higher.
That's right.
It says $80,000 for a nursing home, $50,000 for part-time coverage at home.
Correct.
Those are serious
Correct.
numbers.
And you know, we talk to clients all over the country. So if you're in New York City or if you're in Los Angeles or if you're calling from the middle of the country, the costs will be vastly different. So when we look at just an average number, know that we've taken a segment of the entire United States, and still it's pretty astounding.
When you look at the inflation and cost of living adjustments that we're giving out, what the government is doing, basing it for Social Security and other benefits, I've noticed that healthcare costs are always way greater than the COLA.
Yeah.
And I've noticed that long-term care is right around the same. I mean, you're looking at $80,000 for a nursing home, $50,000 for part-time coverage at home. What's that going to look like in 20 years?
Yeah, and think about where the majority of care is received today. It's not in a nursing home. Mm-hmm. It's in the comfort of a client's own home. And so costs there can really escalate. The figures that we have really are looking at part-time care. What if it were 24 hours a day, 7 days a week? That number could be double.
Mm-hmm. I'm trying to figure out how to anticipate this. I want to be able to have a good retirement. I want to be able to use money the way I want to do it. I want to have a lifestyle that I projected, at least in my imagination. But sometimes I have to come into a reality check as well.
Yeah.
What do I really have to think and anticipate? Now, a couple of shows ago, we talked about if 70% of most Americans that are seniors are experiencing some form of long-term care event where they actually had to pay out some kind of a benefit was paid out, I'm thinking, what is that going to be like as we live even longer than what we've been projected? Now, those costs are going to come online. How can I make a model? How can I accommodate a retirement model that inserts extended care coverage? Because I think another big misnomer, we're going to be talking about this in the days to come. I think a lot of big misnomer is, Maria, that this is way too expensive.
Yeah, you know, individuals that look at long-term care planning and come out on the first conversation and say, show me the top of all coverage. Show me $15,000 a month, show me the most aggressive inflation protection I can add to it, and we've got to stop the presses with that. Mm-hmm. You know, we have to really look at an individual situation. We need to be able to define what they can cover on their own, what they're comfortable shifting to an insurance company to help cover some of the cost. And you should design this plan so that it's taking the sting out of a long-term care event, but it does not have to cover every last dollar.
So really, correct me if I misunderstood you, I think you're saying, though, that most people do not buy and purchase the Cadillac fully loaded plans.
They do not.
They do not.
They do not, but there's a perception that that's where you start. And that's where we are ultimately changing the way people are looking at doing this kind of planning. It's not start with the top coverage amount. It's talk to us about where you want to receive care if somebody's looking to retire in Florida, but today they live in New York. Take that into account. If someone says they choose to live in their own home as opposed to going to an assisted living facility, take that into an account. And at the end of the day, we don't have a crystal ball, right? We don't know what the future is going to hold, but we can prepare for it.
Okay, so I'm an advisor. I'm watching this show. I'm thinking, okay, how do I figure that out? I know I've collected my clients' assets. I have collected all the information. I know what their returns are. I know what I'm getting. I think I've done a pretty good life expectancy test on my client, pretty much know what they're doing. How do I go about to figure out how do I shift risk? How much can I share? I know it's tailored, but is there a rule of thumb to at least start? I'm not starting at the Cadillac price.
Right.
So where am I starting?
Well, the first thing that I would do is encourage a dialogue with a client about what their key benefit drivers are. What ultimately are they looking to achieve with this kind of protection? Is it that they want to cover purely the risk of a care event? Are they concerned about legacy assets? Are they concerned about also accumulating some income as they're doing their planning? These are valid and important questions because today's marketplace for long-term care planning has solutions that could fit any one of those needs. So when from a financial standpoint you sit down and you think about how much can I cover, look at the portfolio. Find out where the funds will come from to pay for this type of premium, that's so very important early on in the process, especially if you have somebody who says, well, I really have a pretty fine budget to work off of. Well, then planning experts will help you sit down and discover how much coverage should be available per day or per month. What type of inflation solution should we look at? How many years should this coverage last? There's so many ways you can adjust it. The first thing is, don't be afraid to have the conversation. Know there are so many different options out there. When you align yourself with specialists that can help you do the proper planning, it's a win-win for the advisor and the client.
It seems to me, Maria, and I just want to comment this before we go to the break. It seems to me the middle class is the one that really has to think about this through. I mean, people who have money that are affluent, they can pay for the premiums no matter how they're going to customize their own policy. And the people that are very, very poor, there's some government programs that will accommodate that. But I think the bulk of America is what we're talking about.
It is, but it's also the affluent individual that we're talking about, Steve. Because as I said in one of the previous segments, it's not just about the financial component that's here. Because when the care event happens, it's not the insured or the individual that's calling us. It's often a spouse or a child that's really unsure of where to go. How do you begin? Which asset do you sell? How do you know where to go to get those premium funds to cover the cost?
We come back from the break, we're going to talk about some of these costs and really kind of get an idea of where we need to start. We need to kind of get to a ground zero starting point. We'll be right back after the break. It's not how much money you make for your clients, it's how much money they get to keep, especially in retirement. But retirement income could cause Social Security benefits to be taxed. One tax advantage alternative is life insurance designed as a non-modified endowment contract that can generate tax-free income without taxing Social Security benefits. These contracts offer differing funding options depending upon your client's risk tolerance. For more information on how life insurance can be part of your retirement planning, just email me at steve@downtobusiness.tv. Brought to you by Ash Brokerage, the practice enhancement company. Well, welcome back to our second segment. I'm with Maria Sarchi, LTC gun and author and expert. And really, I've noticed something about you the last 3 days you've been with me. You always talk about this conversation, this discussion. We're having a kind of a yin and yang. We really are having a real thorough talk about what my last 20 to 30 years are going to look like.
Yeah, we are. And the reason why we're not just talking about one type of solution that can solve all of the care planning concerns is because it will be different individual to individual. This is not, care planning today is not what it was in the 1970s or the 80s, the 90s, the early 2000s. This is a very holistic way to get the average consumer to take a look at protecting their portfolio, protecting their lifestyle, protecting their family, protecting themselves against the financial and emotional risks of a care event.
Well, let's just talk a little bit about real money here. So
Yes.
I've looked at one of the typical standalone, and I was trying to put this up against my own, right? Because I haven't. People always say, Steve, and of course everybody's always asking the host and people who write for a living like I do, Steve, what do you have? Do you have long-term care? I do. And I have a standalone long-term care with my wife and I both on the same contract. Just a little heads up in case you want to say it. Now, the typical LTC, according to your stats, is I really was shocked, $2,500 a year for one person.
Yeah.
Now, that wasn't as bad as I thought it was going to be.
Well, what did you think it would be?
Honestly, I thought we were going to be talking $45,000 to $5,000 for anybody male 60 and above. That's the starting gate number. So even as an advisor, I was shocked that this was way cheaper than I thought it was going to be.
Well, I wouldn't call it cheaper. I would say that we have finally gotten to a place where we are customizing these plans to fit the needs of the client's household budget, to fit the needs of their retirement wishes down the road. So we're not looking at plans with very aggressive or assertive inflation components or cost of living adjustments. We're not looking at plans with unlimited lifetime benefit. On average, we're looking at plans that cover about $150 to $200 a day, whether it's skilled, custodial, or intermediate care, meaning in a facility in their own home or in an assisted living facility. And we're looking at plans that are covering maybe 4 or 5 years on average. We've shifted away from these big, overarching long-term care plans and are looking at something that's quite more affordable for the American public.
Okay, so if I heard you correctly, then when we do customization, we're talking about, because I think the average LTC event, if it's really going to be in a nursing home, if it's really going to be ongoing care, that average time may only be 4.5, 5 years. Is that correct?
True.
So I'm not looking for forever on my timeline of planning. I'm looking to cover a benefit package somewhere around 4.5 to 5 years.
Generally speaking, yes.
Okay, if that's true, and you brought this up 3 or 4 times now, I want to make sure I get this. All right, we're not doing extravagant COLA riders, but what rider am I using? What number, what rule of thumb am I talking about as an advisor?
Well, on average, you want to look at something that's going to grow along with the client. So if you're talking to somebody in their 40s, 50s, you probably want to use some kind of a compounding inflation hedge, something that'd be a little bit more assertive. For somebody who's in their 60s or 70s, maybe you want to use more of a flat line, continued growth every single year, but not a compounding growth. And really, it's a personal preference. So you've heard me say over and over, Steve, there has to be dialogue with the consumer. Why show somebody something so aggressive when the premium is going to be out of reach for them? Have that dialogue with the client so that they know they've got a number of choices before them. There's not one solution that could be a panacea for all.
Yeah, I'm just trying to think of people now, you know, the government always comes out with their Social Security COLA. People are trying to input COLA riders on annuity income. Everybody's got the COLA on their mind.
Yeah.
So I'm trying to figure out where do I land on something like that?
Well, I'll tell you a general starting point, especially if you're talking to somebody in their 50s or 60s, would be something like a 3 or 4% compound inflation factor. But I want to be careful because that is not for everybody. But it's usually a starting place where you can at least start to formulate some numbers to talk to the client about.
I think if we're looking at basic coverage, like you've suggested, not forever coverage, but coverage is going to take out maybe 4 or 5 years. We're looking for baseline COLA that's going to really be pretty in the game. It's going to kind of keep pace. We're not looking for something extravagant. I'm trying to look at the internal rate of return. I mean, everybody's going to put a pencil to this.
Yeah, of course.
So we're going to look at what is the economics of it, what's the leverage of it. And when you look at this, again, we both have different resources that we've used that will show the leverage of this and how this really works on the client's behalf. And this is why this conversation needs to be introduced into retirement planning. I wouldn't be using this as a standalone module. This needs to be incorporated in everything we're talking about as a retirement.
True. And from the financial component, why is this so important, this economic impact event? Well, it's very, very clear to a consumer when they look at the numbers before them that they'll have to come up with this premium of $3,000, maybe up to $5,000 a year if you do a more traditional method, standalone type LTC solution. And the alternative to that is if you're uncomfortable with that premium on an annual basis, let's talk about where the monthly premium. If you're self-insuring, if you do nothing at all, you're choosing by default to self-insure. If you're self-insuring, where will the $4,000 or $5,000 a month come to cover your long-term care expenses? So think about that. If the annual premium is something that's challenging to you, well, then we certainly have to have a conversation around where will those expenses come from on a monthly basis if there's a care event, and we know what the odds are.
Well, that's all the time we have for today. Remember, before moving forward with any of the ideas on our show, always consult your tax advisor, legal counsel, or your broker-dealer compliance officer. Missed an episode? Just go out to our video archives. And remember, you could be wiser as an educated advisor. I'm Steve Savant. We'll see you then.